Hello, my friends. Today is June 24th. My name is Joseph, and this is Markets Weekly. This week, we're going to talk about three things. First, we're going to explain what bank capital is and why so many bank lobbyists wanted to ask Chair Powell about it. Secondly, we're going to talk about what's going on in the UK, where the Bank of England surprised the market with a 50 basis point hike because it seems like they are losing control with inflation. And lastly, we'll talk about what's going on in Japan, where the equity markets have gone parabolic, inflation remains high, and the Bank of Japan doesn't seem to do anything. Okay, starting with bank capital. So this past week, Chair Powell did his periodic hearings with Congress. At these hearings, Chair Powell is asked a whole bunch of questions by a range of congressmen. Usually, these hearings are very boring, and this time was no different. But what stood out to me, though, was how many congressmen were asking Chair Powell about bank capital requirements. It seemed very obvious to me that there was a full court press by the bank lobbyists to press their congressmen to ask Chair Powell about this. Many congressmen seemed to simply have a piece of paper in front of them and read whatever was written on it.
Increase capital requirements. Raise capital requirements by as much as 20%.
Some of the capital requirements and how
Including stricter capital requirements that
some changes, obviously, in capital requirements.
Read whatever was written on it. So what is bank capital? Well, when we think about bank capital, it's different from how we think about capital in the more general sense. Generally, when we think of capital, let's say someone deploying capital or investing capital, we think of capital as an asset, like money that can be invested. But for a bank, capital is a bit different. Capital is a liability that's used to absorb losses. So if you follow my work, or if you're familiar with banking, you know that a bank creates money. When a bank makes a loan, it just kind of creates deposits out of thin air. Being able to create money is a very powerful right of a bank, a privilege of a bank, but it's also highly regulated. And among the many regulations banks face are capital. So when a bank makes a loan, it has to hold some capital against that loan. The amount of capital a bank has to hold is in proportion to the risk of a loan. So if a bank buys a treasury security, for example, which doesn't have credit risk, it doesn't have to hold a bunch of capital against it. But if a bank makes a loan to a private sector corporation, it's going to have to hold more capital against it. Just for example, let's say a bank makes a $1 million loan to a company. If the capital requirements for that type of loan was 10%, then the bank would have to have 10% capital against that loan. Now, capital is expensive. So capital comes in different forms, but generally speaking, it's common equity. And common equity holders usually require a return on equity of at least 10%. So it's expensive for a bank to owe a lot of capital. But it also makes sense as well. Let's say, for example, the bank makes that $1 million loan and then just loses a whole bunch of money, loses all of that $1 million loan, so has to write it down completely. Who bears losses for that loan? Well, the bank is definitely not going to shift the losses to their depositors, right? I mean, you don't put money in a bank and then suddenly the bank makes a bad loan and calls you up and saying, hey, you had $100,000 on deposit with me, but because I made some few bad loans, it's now, you have to share the losses. So now your $100,000 deposit is only worth $90,000. That's not how it works. What happens is that the equity holders, that is to say, the people who put up capital in that bank, they take that $1 million loss. So it's riskier. So the more capital a bank has, the stronger the banking system is, because banks have the capacity to absorb lots of losses. But also, it makes a bank less willing to make loans because each loan, costs more capital. They have to. Capital is expensive, and if you have higher capital requirements, then loans become less profitable, and banks are less willing to make them, or at least they become more expensive. So there's this balance here between the safety of the banking sector, and the availability of credit. Now, banks don't like having high capital requirements because it makes them less profitable. So at Congress, there's a full court press to try to complain to Jay Powell about capital requirements. The context to this, of course, is that in March, there was a banking panic, and Vice Chair Barr at the Fed, who is the one responsible for banking supervision, is rumored to have a new proposal to raise bank capital requirements. The banks got wind of this, and they're lobbying furiously to not increase their capital requirements. And the way they're phrasing this is that if you increase our capital requirements, that reduces the availability of credit, and many small businesses, mom and pop shops, and so forth will not be able to get the loans that they want. There's some truth to that, but of course, banks just don't want to reduce their profitability. And we'll see how this plays out. My own view is that what happened in March was very clearly a liquidity event. And so I think of capital as more of a buffer against credit event. So when a bank makes a loan and someone is unable to pay back, rather than a liquidity event. I suspect that at the end of the day, after all this lobbying, we'll probably end up with some increase in capital, but it'll be much smaller than is initially envisioned, and it's probably going to cover not the small banks, but the medium to larger banks. Okay, the second thing we'll talk about is what's happening in the UK. So this past week, the Bank of England surprised the markets by hiking 50 basis points. Now, the Fed, of course, started with 75 to 50 to 25 and paused, but we have the Bank of England seemingly accelerating to 50 basis points. Now, the reason for this is actually pretty simple. Inflation in the UK remains high and seems to be accelerating, and wages seem to be accelerating as well. So in the US, for example, inflation has gone steadily lower. The same thing in the Eurozone, but not so in the UK. It seems like the Bank of England is losing control of inflation, and inflation most recently was around 9%. So it's very, very high. The causes for high inflation are many. You have structural causes that we see in the US and the Eurozone, where in part due to demographics, there's a labor shortage. But like the Eurozone, there's also an energy shock. And unlike the Eurozone and the US, they also had events relating to Brexit, where it seems like it's more difficult to get immigrant labor. And perhaps it affects import prices as well. So inflation is rising, but at the same time, many people in the UK are feeling squeezed. Prices are rising and they're not able to afford as many things as they used to. So they are striking and trying to obtain higher wages. Right now, there's strikes by doctors, there are strikes by academics, there are strikes in many sectors of the economy. There's a cost of living crisis. So these strikes and these labor bargainings have been effective, and wages in the UK are rising as well, but not as much as inflation. So what you're seeing is what seems to be the beginning of a wage price spiral. So in general, when prices rise, you wouldn't expect them to rise indefinitely, because let's say everything goes up in price by 10%. Well, some people won't be able to afford those high prices. And so eventually businesses will be forced to cut prices, and inflation, if not reverts, at least declines. So prices increase at a slower rate. But if you have, let's say, prices increasing at 8 or 9% and wages also increasing at, let's say, 7 to 8%, well, that means that people can continue to afford higher prices. And so companies can continue to raise prices at high rates, a wage price spiral. The Bank of England is desperately trying to get ahead of this by hiking rates aggressively. And the market seems to expect that Bank of England would ultimately go as high as 6%. They're at 5% right now. And that's going to be pretty painful for a lot of people there, because in general, unlike the US, their mortgages tend to be shorter dated. And so eventually, when everyone renews their mortgages, they might end up with higher monthly payments, although there is some legislation that seems to be trying to soften the pain a bit. what was most interesting to me in this episode was that when the Bank of England hiked rates, surprisingly by 50 basis points, the pound actually ended the day a bit weaker. Now, usually you would expect that high interest rates be associated with a strengthening currency, and that's how it usually works, unless, of course, you are more of a developing economy. And so in those contexts, you hike rates, but then people look at that high rates, but also see the amount of distress in the economy, and they actually sell your currency. And so that's a really interesting relationship we want to watch now, where the Bank of England continues to hike rates, but because the damage to the economy is so large that people began to sell the pound and get money out of the country instead. Now, the last thing I want to talk about is what's happening with Japan. Now, I haven't been talking about Japan, but there's been lots of really interesting things happening there. First off, let's look at the Japanese stock market index, the Nikkei. The Nikkei looks like it's going parabolic, just going straight up. But of course, if you zoom out a bit, you'll notice that they still haven't regained their all-time highs from quite some time ago. Now, if you look at their inflation, you also notice that Japan, like the rest of the world, is experiencing high inflation, or high from a Japanese standard. For context, Japan struggled with low inflation or deflation for many, many years, but only recently seems to be experiencing high inflation. They have an inflation target of 2%, and today inflation is about 4%. So their inflation is way above their target. And I suspect this is probably related to the rise in the Nikkei. So the Bank of Japan, unlike the rest of the central banks in the world, has actually kept rates unchanged since pre-pandemic. So their policy rate is actually negative, and they have yield curve control where the 10-year is not to rise above 0.5%. So, they are really standing out across the developed world. And this has had two consequences. One, of course, is that the yen has depreciated tremendously against other currencies. So you have rates at 5% in the US, you have rates negative in Japan. So it makes sense for some people in Japan to want to move money out of Japan and into the US where they can get high interest rates. And that process causes the yen to depreciate, and it's depreciated significantly. But I imagine, though, if you are a Japanese investor, you're sitting at home, you have a lot of cash, you notice interest rates are very low, you'll notice that inflation is 4%, where do you put your money? Maybe one of the places that you want to put your money is in the stock market. And if everyone does this, it becomes a self-reinforcing cycle where people see prices going higher, there's a lot of momentum, and everyone chases that, although it appears to be having a pullback right now. So I think all these factors, inflation, low interest rates, are related. Now, the big question in the market is the Bank of Japan going to adjust their policy? Are they finally going to hike rates like the rest of the world? Everyone in the world is really watching this, because if the Bank of Japan were to tweak their policy, say, for example, adjust their yield curve control to be, instead of 0.5%, maybe 1% and so forth, that's going to reverberate throughout the global financial system, because global bond markets are tightly connected. If the Bank of Japan were to raise their interest rates, that could easily cause interest rates in the US and the Eurozone to rise as well. So any surprise there would imply higher rates for the rest of the world. What the Bank of Japan is saying, though, is it doesn't seem like they're thinking or even suggesting that right now. In fact, when you look at their recent statements, it seems to suggest that they think that inflation is going to, even though it's 4% now, it's going to trend lower going forward. In a word, inflation is transitory. Now, that sounds familiar, right? And maybe the Bank of Japan will be correct. Japan, of course, is a very interesting economy. It's different from the rest of the Western world in a lot of key ways. But like them, they are experiencing high inflation, and perhaps it'd be not transitory. But so far, though, if the Bank of Japan believes it's transitory, then they're going to keep interest rates low. They're going to keep yield curve control on. And that suggests that whatever is happening now, the depreciation of the yen, rising stock market might persist. Definitely something to keep watching. One other note is that a very good observer of the Bank of Japan, Weston Nakamura of Blockworks, has also suggested that part of the reason that the Bank of Japan might be reluctant to raise interest rates is that in Japan, the debt level, the debt to GDP of public debt is very high. It's the highest in the developed world. And when you hike rates a little bit, you can cause the interest expense to go up a lot. And, that makes the debt burden even less sustainable. So there could be some fiscal considerations as well. I'm not sure, but definitely something interesting to watch going forward. Okay, so that's all I've prepared for today. If you like what I'm producing, please remember to like and subscribe. And if you're interested in learning more about the markets, you can check out my free online courses. And if you are a bit more experienced in the markets, you can also check out my blog, fedguy.com, where I write weekly research pieces on what's going on in the markets. Thanks so much, and talk to you guys soon.